And why would I do something so utterly boring?
It is
Y-
boring. It's cutting
Yeah.
coupons.
I wanted to move into the private equity world. At
Mhm.
at the end of the day, the family office will ultimately go away.
Hello, and welcome to Mornings with Joel, commercial real estate podcast, where we focus on rising stars and established players in commercial real estate and talk to them about how they are building legacies in today's marketplace. Hello, thank you for joining the Mornings with Joel CRE podcast. We're very excited to have you with us today. And we have a special guest that is a little outside of the box of who we generally have on the show, but we thought that this would be very interesting and you would get a lot of value out of it. So we wanted to bring on Mike Kron today, who's going to talk a little bit about net lease opportunities and his background in multifamily and other things. And we look forward to a very exciting meeting rather. So Mike, pleasure to have you today. Thank you so much for being with us.
Joel, great to be here.
Thank you. Thank you. So Mike, I see some gray hair up here. You didn't just start doing this yesterday, I would suppose. It looks like you've been around the block a little bit.
I've had a little bit of experience in the real estate world. I got out of school in '87. I was practiced real estate law for about 6 years. Decided that I really wanted to be on the other side of the table. And at the time, my father-in-law asked me to come work for him in his multifamily family office. He had about 2,500 units. He was starting to get to the point where he needed somebody to be his right-hand man and kind of oversee things. So it was a great opportunity, and I jumped at it. And 33 years later, I now run the show. We've been able to grow from 2,500 units when I started to over 14,000 units now. That didn't happen all at once. It happened in a progression, but we kept moving. He owned a lot of stuff in California. We started selling that and moving to Texas way back in the 80s. When you
Okay.
could shoot a cannon through Texas and not hit anything. People don't remember that don't have gray hair, but
Yeah.
that was how it went. We started getting into the Arizona market, which we really love. And I've been basically running the show now for the group as we continue to grow. We're still building. We built about 4,000 apartment units.
Okay.
I'm building 760 doors right now in Gilbert, which
Okay.
we've
Yeah,
got
I
about
know.
175 residents.
Mhm.
It used to be a sleepy little town. It's not so
Yeah.
sleepy anymore.
Very true. Very true.
And
Yeah.
and I've got another project there, another 568 units that we're getting ready to start. We're going into the town for design review on that. So we're continuing to grow, in measured paces, but we love the multifamily world. We love what we're doing. And, we always taken sort of a long-term view of the world.
Yeah.
But that wasn't enough for me. I had to jump out and start my own private equity group. And we're in the process now of trying to blend these two together,
Okay.
which ultimately I think will happen. But we started raising money for our first real estate fund, a $100 million fund, buying single tenant net lease retail properties with
Yeah.
high credit tenants.
So let me
And
do this because I want to
yeah,
get into a lot of details. So give me
sure.
1 second. I want to go back to the multifamily part because in actuality, I didn't know you were still doing multifamily,
Yep.
which is interesting. So I was curious about the pivot. But in Texas, just to kind of go there for a second, what markets are you mainly focused on and that type of thing? Because I know you say Texas, but Texas is a big place. So
Texas is a very big place.
yeah.
Yeah, we've been in Dallas and San Antonio in a
Okay.
very large way for a long time.
Okay.
I've built probably 1,500 units in the San Antonio market, less
Okay.
than that in the Dallas market. But we've always liked those. We're also in Austin in a little way. We've been there in a big way. We've gotten out, we've gotten in. We keep sticking our toes in the water to see how it goes.
Yeah.
But not a huge market for us. And we only touched the Houston market very briefly when I first joined him,
Mhm.
and we sold those properties fairly early on. And no knock against Houston, we just didn't know the market and didn't feel comfortable there. So stuck with what we knew, and that was Dallas, San Antonio, and to an extent Austin.
Okay. Okay. Well, that makes sense. Just out of curiosity, is because I hear a lot of things about Houston and a lot of folks actually trying to get us in the Houston market. My concern is I know of clients of ours that have had hurricane issues, blowing through Houston and the insurance costs going through the roof. I mean, is that part of the reason you're out of Houston, or is it just you don't really know the market and have been pretty active in other markets?
That's part of it. I mean, we owned a property, and this isn't, in Texas City, which is not Houston. It's far south.
Right.
And we were 6 blocks off the Gulf. This was back in 89, 90. In the stores on the second block off the Gulf, they said beachfront property 2000 because they were losing the Gulf slowly and surely to accretion. Yeah, the hurricane risk is definitely a factor to us. We face hailstorms in Dallas and to a lesser extent San Antonio. So, we've sort of pivoted to Arizona for a lot of those reasons, but the market is still very good. But I think the bottom line, Joel, is we just didn't know the Houston market that well.
Yeah.
And we just figured let's stick with where we really feel comfortable.
Gotcha. And very briefly, just about Austin. Obviously Austin was like everybody had to be in Austin, and the prices went through the roof. Hopefully you sold at the right time. A lot of that has come back down because of the hysteria has kind of died down. What's your current thoughts on the Austin market right now?
They're one of the markets that's working through the oversupply issues in a very significant way. I mean, we've seen it in the Phoenix market as well, but I feel comfortable as to where they are. Part of the problem that Austin has always had is that they haven't built out the infrastructure, the roads, the highways to an extent that makes it comfortable. I mean, there was a running joke that you could get to South Austin faster from North San Antonio than from North Austin. And there's some truth to that.
Wow.
So the growth comes with a price. And whereas in San Antonio and Dallas, they're constantly building new toll roads, new freeways, and expanding their presence, Austin's been a little slower to do that. And the property we own actually is on the south side of town, down by Onion Creek, a country club down that way. And we like that a little bit better. It's closer to the airport. It's got some appeal from that standpoint. It's a little easier for us to manage that because our guys from San Antonio can get up there pretty quick, where if they had to go into Central or North Austin, it would be a day or two to spend up there. But for us, it's really been the infrastructure. When we were there in the 90s and early 2000s, and we could start to see what was happening. And we either said, look, we either need to get bigger or we need to get out. And we made the call to get out. We did reasonably well, maybe not as well as if we had hung on another 10 years, but we did okay. And, what we invested in worked well. So I don't have any regrets.
Gotcha. Well, that sounds real good. And I definitely understand the Phoenix market, and, it's a great place to be. And so I'm not really surprised you're in Texas and Arizona. Those are two Sunbelt regions that people like. So a lot of value there. And Phoenix is growing like crazy. So again,
It really is. And it's funny. I was during COVID, and we all remember all the stuff we had to do during COVID.
Yep.
I was on they did a remote happy hour with a group of real estate guys, and I was on the call with a bunch of folks from California and Washington State and me from Arizona and Texas. And they're going through the horror stories of, the rent collection was 65%, 70%, 50%. And they looked at me and they said, how are you doing? And I kind of sheepishly just said, well, we're like 98.8. Turns out that folks in Arizona and Texas, when they sign a lease, figure they need to pay it. And that was just the mentality. And we've, one of the reasons we're in those states and love them.
Well, can't argue with that. I have no comeback.
Yeah.
That makes sense all day long. Oh man. So you're doing well in multifamily, and you decide to make this pivot. And, generally we see a pivot toward retail or industrial or something like that. But you decided to pivot toward triple net lease, single tenant properties, from what I understand. So tell me a little bit about that. What was the mindset behind that pivot?
And why would I do something so utterly boring?
It is boring. It's cutting coupons.
I wanted to move into the private equity world. At the end of the day, the family office will ultimately go away, and I would like to pivot with that into a fund
Okay.
and buy that portfolio. So looking with that is my guide star. I said, okay, I need to create a presence in the private equity world. I need to build up a reputation. And anybody who starts in that area knows one thing for sure, that if you want to do fund two or fund three, fund one had better be successful.
Yeah.
And we looked at a lot of different options, even though my background was multifamily, I've touched a lot of different areas. I own single tenant stuff. I own office buildings. I've owned mini storage. I've seen the world. And to us, the one thing that I always heard from people was when I was talking to potential investors, you know, I have a lot of investments, but I never see any cash flow, and all they do is call me and want more money. And I said, I can do this differently. And that's sort of how we got to single tenant. It was something that I knew we could execute on. We're doing the high credit tenant only on, our 14 tenants are all names you would know: O'Reilly Auto, 7-Eleven, CVS, Sherwin-Williams, because I figured that I could get the same kind of return with those names that the REITs and the private equity players in this space are doing with their funds, where they've taken on a lot more risk. And I knew I could get a 5 to 6.5% cash flow out of that. Then for me, it was really a matter of finding the right time to launch it. And I wanted to launch it in 2022. But if you recall, that's when the Fed decided they were going to start raising interest rates. Well, what we do doesn't work very well into that environment. The cash flow is okay, but the end game doesn't really play well when interest rates are going up, because there's a high correlation between cap rates in our space and interest rates.
Sure.
So I said, no, guys, we need to chill for a little bit. We need to wait and let's see what happens. We'll get to a point the Fed's going to start lowering interest rates are going to start coming down. Then we can jump in. And that's really what we did. We took the friends and family money. We'd raised 2.3 million of the 100 that we wanted to raise. We deployed that in fall of 24 when I felt the Fed had peaked and was probably going to be on a downward trajectory, which is what's turned out to be the case. Cap rates have come down a little bit, or I should say, actually, they've really stabilized in our space, which is what I really want to see. Now we can go into it with a lot of confidence that cap rates will start to come down as the Fed starts to lower interest rates. I don't know how fast that's going to happen, but all the tea leaves are pointing in that direction. And I think most people would agree that with a Kevin Warsh-driven Fed, I think we're going to see a few more rate cuts than we might under the current administration of the Fed. So it was a perfect time for us to jump in, and I feel comfortable we can build out this platform, build out the number, 70 to 80 stores if we're fully successful raising 100 billion. And that makes us very enticing to some of the bigger players out there, the Agree Realties or Blue Owl or all those people who are doing exactly what we're doing, but on a bigger scale and need scale to be able to buy.
Right. So let's do this. I have a couple of questions on that. We're going to take a quick sponsor break, commercial break, and we'll be right back.
The Impact Air 99. We asked real people, try the Impact Air 99.
Breathable, light, but protective.
Feels very comfortable wearing it. It looks cooler.
It's almost surprising how much air you can get in.
Engineered with 6 layers of nanoscreen technology that blocks over 99% of viruses and bacteria while allowing you to breathe freely and speak clearly.
My glasses are not fogging up.
I could wear this all day.
Sage Data is your automated recruiting hub for any size organization. The concept is simple. If you have lists of prior applicants, Sage Data will clean, update, and convert those lists into digital resume profiles that are searchable. You can also post unlimited jobs in the system, and our AI will automatically search the database and bring back potential candidates for you. Head over to sagedata.io.
All right, and we're back. Thank you so much for hanging in there with us. As mentioned, we're talking to Mike Kron of his net lease fund of Guardian Net Lease. So, Mike, we were just talking before we went to break that you decided to focus on single tenant net lease. You're expecting a trajectory of lower interest rates, which bodes well And you had also mentioned about some of the larger players in the marketplace that, you could certainly get the attention of it at that particular point as you continue to scale and grow with the size you want to grow the portfolio. Is that to eventually disposition it as a portfolio, or are you looking to hold these on more longer term? Because I know it looks like you're churning a little bit with every 5 years you're entering and exiting. So what's the model there?
For us with this, it definitely is a buy and then sell
Okay.
model. When you're in the net lease world, you're always based on lease term, and values are based on lease term. And as you get a declining lease term, you can negatively impact the values, and we don't want to be in that position. And beyond that, I got into this and I looked at a lot of private equity offerings, and they all had the same characteristic. The promoter, the sponsor, was the one making the money.
Mhm.
And if you were lucky as an investor, you made some money as well. And I just said, you know what? I can do this differently. If I do well for my investors and I buy things when it's appropriate to buy and I sell them when it's appropriate to sell, I'm going to make plenty of money. My investors will do very well. And that's all that I need to do. So when I look at this, I'm really looking at this real estate cycle
Mhm.
where, you know, the if you follow the Federal Reserve over time, and I get a little geeky when I do that sometimes, they tend not to change directions very often. As a matter of fact, very infrequently. So when they start moving in a direction, usually you have a pretty good run in that direction until something happens and then they change and they go back the other way. We want to follow that interest rate cycle down along with the cap rate cycle. Once we get to the bottom and or really the top in value, and we feel that, now they're probably done lowering interest rates and cap rates are probably at the lowest level they're going to be, then we really want to look to unload the portfolio and get out. I don't need to keep making my fee on this and hang on for my benefit to the detriment of my investors. I'd rather do it the opposite way. If I sell it when it's good for them, it's going to be good for me too.
Mhm.
And then we can move on to the next one.
Gotcha, gotcha. And are you mainly focused on assets in Texas and Arizona as well?
No, we're looking all over the country. We really like the Sun Belt, both Southwest and Southeast. Our first three stores, one's in Georgia, one's in North Carolina, and I love the Central Midwest. We own it. We have a store in Wisconsin,
Okay.
and I like the mountain regions. Really, just staying out of the West Coast and the Northeast for a myriad of reasons. But we like the nice growing economies, which will support neighborhood retail. I mean, if our premise is, look, we're going to do neighborhood retail, relatively Amazon resistant businesses.
Yeah,
I want a population base that will support that retail.
yeah, yeah. No, that's a valid point. You don't want to get Amazoned. So that's
No, no, they are the 800-pound gorilla.
yeah, they certainly are. They certainly are. So the model right now, if I understand correctly, is you're buying single tenant net, I'm assuming triple net lease properties. Is it a minimum of a 10-year lease so that there's 5 left when you exit? Because obviously, you're getting kind of close at that point, or you're looking to structure more 15 to 12. I mean, is there a little insight you can share on that as to what that model looks like?
Sure. No, we're definitely looking for at least 10. I'd prefer 12 going in.
Okay.
We've been lucky. There's a little bit of distortion in the market right now. If you think about these things, they're usually the back end of a 1031 exchange.
Yep.
Mom and pop have an apartment building. They don't want to manage it. They're getting
Mhm.
older. They want their kids to have mailbox money. They buy one and they hold it forever. And I mean, I have a Walgreens that I'm going to hold forever because I love the real estate.
Yeah.
But that hasn't been happening with interest rates elevated. There haven't been a lot of transactions or nearly as many.
Mhm.
So developers, I mean, O'Reilly and Dollar General and all those stores, they're all growing. They're building new stores. Well, developers are building those, and when they're done building, they need to get out because they want to go build the next one.
Really.
We were able to buy our first 3 stores directly from the developer because they needed to get out at
Mhm.
prices that I wouldn't have expected. So we got brand new 15, 14-year leases.
Okay.
Ultimately, if we can get to about a 12, 11, 12 on entry, that'll give us 7, 8, 9 on exit. And if you look at, I look at the quarterlies from all of the REITs in our space. If you look at them, their average lease term is about 7 or 8 years. And that really is what they buy. Everybody thinks, oh, you got to have 10, 12, 15.
Yeah.
They buy them, they'll churn them, and they'll do what they do to keep value there. But they love the cash flow. And that really fits right into the model of what they would buy. So to your question, yeah, we want to have some term left when we go to sell it because that makes it more valuable.
Yeah, absolutely. And that's why I was asking because, like I said, you get to the point where if you're below 5, it becomes almost impossible to sell, unless you're going to fire sell it. So you gotta try to keep it up from that standpoint. But from what you're saying, you're actually buying brand new. So, or in some cases, if you're buying from the developer, you're buying brand new. So
Well, look, we're going to have some stores that we buy, and I will probably buy them a little later into the cycle, like the Advanced Auto or some Starbucks that only do 10-year leases. Sherwin-Williams, I believe, only does 10-year leases.
Right.
So you know what you're getting. But I'll buy those where I probably will only hold them for 2.5 or 3 years.
Okay.
But the cap rates are commensurate with the fact that they do shorter term leases. From an operating standpoint, I never really understood that from the tenant standpoint because you could be paying lower rent if you gave the landlord a longer lease, but I'm not in their business, so I'm not gonna go there.
I understand. So let's do this for our audience because we do have from time to time newer people in the commercial space. Let's make sure we define our terms. What exactly is a triple net lease? I've used that term a lot in this discussion, and obviously you've used it. What exactly is it? What's the advantage of it? Why would you want a triple net? Just give us that little background so that people understand what we're talking about here.
Sure, no problem. And in all fairness, we will do some double net leases, so I'll explain the differences.
Yeah.
A triple net lease basically means that the tenant is paying all the operational costs of the property. They're paying repairs, they're paying insurance, they're paying property taxes. So, when we get our rent check on the first, that's it. That's our income for the month. We know exactly what it is. We're never going to have to pay a property tax bill. Now some Dollar General, for instance, we have to pay the property tax and they reimburse us. But at the end of the day, triple net means it's net of all expenses. Double net, on the other hand, usually entails the landlord being responsible for building and structure. So the exterior of the building, the roof, the paint on the exterior of the parking lot will be responsible for. And, we'll hold a reserve for that so that we have money to take care of those things as they arise. I owned an office building in San Antonio, still do. I'm selling it to buy some triple nets to put into the fund or this opportunity, but that we did full service gross, which means that I pay for everything.
For everything, yeah.
So if property taxes go up, if insurance goes up, it's all on me.
Yeah.
So the advantage, they always call triple net leases mailbox money. And the reason is you get the check in the mail, you stick it in your bank account, and you don't have to worry about anything except save for the loan payment if you took out a loan to buy the property.
Sure.
Other than that, it really is net of all expenses.
Right, exactly. So, and obviously people could see the value of that. It almost sounds too good to be true, if you will, but no, that's the way triple nets work, and they have for years, and it is what it is. So let's talk about the other side of it, because anytime someone invests, you got to look from the standpoint of risk mitigation. So let's talk about that. You have it's almost the same issue that you face sometime in industrial. You have a building, and let's say for whatever reason, that tenant has to leave. The corporation gets into trouble and they have to shut down stores. And there are provisions in the lease that protect you. I know about that. But how do you describe that risk profile that they have to consider when it's no longer mailbox money? You have a particular, like Toys R Us, for an example, right? They went under, or Circuit City, or some other name brand. What do we do in a case like that, Mike?
Well, we started out, and as I said at the outset, we wanted this to be a safe investment. And if I'm going to be safe, I'm going to take all the precautions I can to avoid exactly what you're talking about. The
Right.
way we look at the world, we will only buy a store if if the lease is a corporate lease or a corporate guaranteed lease, meaning I've got O'Reilly Auto's credit on the hook. So if they leave, they're still paying me rent. I may have a dark building, but I'm still going to get the rent check because my only risk is that one of those companies goes out of business.
Right.
And if that happens, we all have a lot bigger problem.
Mhm.
You know, now I watch the financials of those companies very closely because that's what I'm investing in, really, the credit of those tenants. So we will do that. The other thing that we always do when we're looking at any site is look at the surrounding market. And the best example I can give you is the Walgreens I own. I've run that down. I intend to own it because I like the real estate. I have like 2 years left on the lease, and everybody's like, "Oh, Walgreens they're going to leave." Well, the first thing we do when we go into a market is we say, "Okay, what's the lease rate?" Well, my lease rate on the Walgreens is $18.50 a foot. What's the market rate? Market rate is 23 to 25 a foot. I'd actually be happy if they left, but but I'm happy to have the check every month. As long as we know that our lease rate is lower than the market rate, that tenant has a disincentive to move because they know that if they move, they're going to end up paying more rent.
Sure.
We never want to be in. You see this a lot with Starbucks, and you have to be very careful because they will sign leases above market and everybody will get all excited and they'll be really happy until the lease runs out and Starbucks moves. And then they're like, "Oh my God, I own this small little drive-through building with no tenant," because they went to the next cheapest alternative.
Sure.
That's just part of the underwriting that we go through when we look at these things. But for us, the biggest one still is having the corporate parent on the hook for that lease. You can buy stores that are franchisees owned, and I saw one come through yesterday that was a KFC. This guy owns 800 KFCs. I'm sure his financials are great. I don't have access to them. I can't underwrite what I can't see. So I just don't want to ever take that risk.
Sure. Yeah. Yeah. That makes sense. That makes sense. Now, in that example that you used of Walgreens, for our clients as well, or not clients, but our listeners to the show, how do you also, or have you used that as an opportunity to participate in their percentage of profits on the lease in order to generate additional revenues because you're actually leasing at a base rate that's below market? Or do you do that?
We most of the leases, and we end up with leases in place, so we're sort of stuck with whatever the
Okay.
developer or the prior owner had negotiated. Most of the leases have percentage of revenue clauses in them, but I could tell you from experience that you're not going to get there. I mean, they would really have to do way beyond what they would normally do in a store to be able to get there. I get my statement every year from Walgreens, and the percentage is, you know, 20% of what they would need for me to ever see anything like that. The bigger protections for us is that a lot of those leases have rent bumps. It used to be every other year. Now it's every 5 years. Typically you'll see 5%.
Okay.
So 1% a year, sometimes 10%. And that really is to compensate you for the fact that these are long-term leases. You don't have to worry about inflation of expenses, but there's still a growth trajectory there that we can accomplish.
Gotcha. So, okay. So you're still able to participate on the upside from that standpoint and do business that way.
Sure.
As it grows. Yeah. Yeah, absolutely. So that's quite interesting. So there's no markets that you're actually locked out of. Is there a particular asset that you or tenant rather that you prefer over another tenant, or do you look at it more on the type of industry that they're in? Like, do you prefer Papa John's over an auto repair shop, or does it really matter?
To us, we self-selected those things up front, and we list 14 in our platform that we will buy.
Okay.
From the all the way from DaVita Dialysis and Fresenius up to 7-Eleven and Tractor Supply. And I feel pretty comfortable with all of them. What I look at more than that is trying to make sure that I'm creating both tenant diversity and geographic diversity so that, if anything happens, we're relatively well protected. I mean, I feel pretty comfortable in our underwriting of these companies. They're all top level companies and growing, but things still happen in this world as we have seen.
Yeah.
I want to be sure that I don't own too many of any one tenant and I don't want to own too many in any one place just in case stuff happens.
Yeah. Yeah. So the diversification is something
Yeah.
that you're looking at even greater than what you've done on the multifamily side.
Yeah, no, 100%. And, as I mentioned earlier, some of it has to do, will ultimately end up revolving around lease structure because I want to buy the shorter term leases later and the longer term leases earlier.
Yeah.
So by nature, I'm going to end up looking at O'Reilly and Dollar General and CVS and, maybe Tractor Supply and 7-Eleven. Even now, Starbucks is doing some 12-year leases, which is encouraging. So we'll look at those first and then filter our way down to some of the ones that are shorter term in nature.
Okay. All right. Gotcha. We're actually at 40 after the hour. We're going to take a quick break and we will be right back here on the Mornings with Joel CRE podcast. Hang tight. We'll be right back with Mike Kron.
How do you build a company that lasts? One with a solid foundation that gets better with time, transforming the first dollar in your bank account into something more, building a product, a team, a culture, expanding to new countries, currencies, and customers, and accessing the capital you need to grow. How do you do all of that? With powerfully smooth banking that keeps you focused on bringing your vision to life.
Step into the future with EcoCrypt, a platform unifying decentralized finance with real-world utility, where value flows freely. From gaming achievements to real-world assets, everything can be tokenized, fractional, and accessible in one trusted ecosystem. For gamers, investors, and global communities, EcoCrypt is breaking down barriers and democratizing finance. Join the revolution. Visit EcoCryptUSA.com today.
All right, welcome back again to the Mornings with Joel CRE Podcast. We're here with Mike Kron, and we're talking about his platform here at Guardian Net Lease Fund and what they're doing in this particular space. Mike, I appreciate all the insights that you've been giving in that regard, but you've got a background in development as well. Have you ever thought about being on the development side as well? And, maybe buying some of the stuff after you develop it? Or, I mean, it's like you picked the lane. Is there any reason why you haven't expanded that lane?
You know what? I think all things are possible down the road.
Okay.
With our first fund, I really wanted to focus on the cash flow aspect of it so that people were getting checks and weren't taking the development risk. Even though from where I sit, that's a relatively small risk. If I've got a tenant, it's a build to suit for a tenant.
Right.
I'd love to build the stores and have them and then just have them in my portfolio. There's a lot of attraction to doing that. But that's a different kind of an investment vehicle for people, and they need to be willing to wait to get their money.
Right.
Because obviously when you're building, there's no cash flow, as we demonstrate every time we build an apartment complex. You have to get to, we're happy the one we're building right now. We have 175 tenants and they're paying rent. So we're finally cash flow positive.
Right. Okay.
But yeah, it's something I would definitely like to think about, but just not with this fund. I want to be very specific and intentional about what we do here.
Okay. All right. Gotcha. Well, that makes sense. What's your typical footprint? Because obviously, as a single tenant operator, you can go from the Starbucks, which is a little teeny thing, to Walmart at 300,000 square feet or something, maybe 100, 150. So what size do you typically like for your fund? And why?
This one, we did what we consider to be small box retail.
Okay.
The Walmarts, the Lowe's, the Home Depots, those are big box retail, and they have a different set of underwriting that you need to do with them. The small box is what we're focusing on. Typically, you're in the 7 to 12, 13,000 square feet range for a store. The bigger ones typically being the drugstores or a Tractor Supply or something like that. The smaller ones obviously being like an Advanced Auto or a Starbucks and things of that nature. And the reason for that really is that if, God forbid, we did end up with a dark store, those are a lot easier to re-tenant. When you have a big box store, there's only so many names that can go in there. And now you're suffering a big downtime, even though we're getting the rent checks. You still have a dark store for a while, which is never real good for resale. And you have to deal with that. With our stores, if we go out, there's other mom and pop businesses that can come in. I'm not going to be as happy as I would be with a credit tenant, but I probably will get more rent for it, and I can get it done relatively quickly. And that really was the beginning and end of that. We're not looking at stores like Pep Boys, for instance, because they're a single use building. Once you have the roll up doors, it gets a little harder to repurpose that building. When you have a CVS store or an O'Reilly Auto or sure, they're pretty much just a box.
Yeah.
And it's easy to get another tenant in there, and the build out is expensive, and you can get it redone. So we just looked at that and said, this is again a safer way to approach this problem.
Yeah. No, I get that, and that makes a lot of sense from that standpoint. Because I was going to ask you about that. That was actually my next thought. Do you at some point grow to a big box type format, or do you stay smaller? Looking at your fund model, you're talking about 80 assets over 100 million. So that pretty much answers the question that you're looking to stay in a smaller footprint from that standpoint. So, and you believe you'll continue that route here on out as it stands right now, I guess, for the most part.
Yeah, we're in the 100 million is equity. We'll have 65% debt on that. So
Okay.
our average deal size is about $3 million.
Okay.
If and when we're successful with this one, we definitely we're thinking about a big box platform for our next one, where now you're talking about raising 500 million or 750 million to go buy bigger stores. That's a little different play, because now you're looking at it more from a long-term perspective, and now you're in business with those tenants. And there's a lot of great stores out there. It's a question of at what point in the cycle can you buy them, and how long do you want to hold them? Or are you looking at essentially recapitalizing into a private REIT or some other structure just to own the real estate? I mean, I'm my multifamily, I look at the world entirely different. I want to hold assets forever.
Right.
I like the cash flow. Now I want to sell some and buy some new ones and keep the average age of the portfolio down, but I'm not looking at them as a cycle type of real estate investment. I'm looking at them as a long-term hold.
Yeah.
And that's a different platform.
Right. No, I certainly understand that. And based on your model, well, like you said, you're looking to leverage that up because that's 100 million in equity. So you'll leverage that up from that standpoint. And why don't you talk to me about the fund? What type of returns and other things that you want our listeners to know that might be interested in investing in your fund?
Sure. Now, we started with cash flow, which I felt was really important. We've gone through a year now, distributed quarterly cash flow at the 5% rate to our investors. Depending on where we buy and what interest rates do going forward, the cash flow is going to be in the 5 to 6.5% range. And that's paid out quarterly. We don't take anything from the cash flow other than our fee, which is just a 1.5% fee. Everything else, other than some very small operating costs, go directly to the investors. We've watched that through. Obviously, the investors with the one big beautiful bill now get 100% depreciation or on the accelerated depreciation, which definitely helps those that either need some passive losses or want to shield the income from this investment. It'll essentially look to them like a tax-free investment when they get done with all the depreciation. And on the back end, we're projecting an overall return in the mid to upper teens based on where we see cap rate compression. And we publish a chart as part of our investor presentation, which shows the sensitivity of if we buy at this cap rate and we sell at this cap rate, here's what the return will look like. Because we want to be straightforward with investors that this is where we think it's going to go, but anybody can throw a dart at a board and say that's what I'm going to hit. But rarely do we actually hit that spot. Usually we hit something else. And I want investors to know what it looks like, both good and bad. We were talking with somebody yesterday and he said, well, the one good thing, he goes, I invest in a lot of things where the end value could be zero. I invest in a business, growing business that it may not hit and they may go out of business and I get nothing back. He goes, your real estate's never going to be worth nothing. It'll always be worth something. And,
Absolutely.
to us, that's the catch. The other nice thing that we do, because again, I wanted to be very investor centric, we take 10% on the back end out of the profits, but that's after the investor gets all of their money back. And I don't play the game where I consider my distributions along the way as a return of capital so I can make the return look better on the back so I get more. Those are cash flow. That's different.
Yeah.
Once we sell the properties, if I raised 100 million, I give 100 million back to the investors and then we split it 90-10. I also own a brokerage, which is where a lot of our experience in the single tenant world comes from. My team there has been at this for 25 years. Since we're getting commissions on the buy side, we're paying the buy side costs for the investors. So when the investors get this, it's a pretty clean investment for them. And that really goes back to my initial point that I think I can do this differently and be really successful and have the most important thing for me is getting investors and having them trust me enough to want to invest with me again.
Yeah. Well, that's always the starting point. What type of cap rate spreads are you generally targeting on this investment?
We're targeting a 675 entry cap rate. And that's, some assets will be in the low sixes, some will be in the sevens.
Yeah.
With the first 3 deals we bought, we were at about 6.7%, and that was with 14-year leases.
Okay.
The cap rate compression really depends on where interest rates go, but
Sure.
the data that I look at says that our space is about 76% correlated to the 10-year treasury. So if you see a 1% drop in treasuries, you should see a 0.76 drop in cap rates in our space. And historically, that seems to have been about where things went.
Okay. So if you see that 0.7 drop in cap rate, are you looking to exit at that point? Or are you just going to wait and hold the 5 years, or what are you doing in a case like that?
We're gonna, and this gets to the governance really.
Okay.
We want to see the interest rate cycle bottom out, whether that's in 2 years, 3 years, 5 years. I want to see that cycle bottom out because then I can feel pretty good that cap rates are at or near their bottom. And that's where we really want to sell. If, for instance, we saw interest rates start to move up, I mean, I'm not talking about the temporary stuff that happens like what's going on right now with the war, but if we see it structurally start to move up, that would be a cause for concern for us that, we might want to exit earlier to preserve capital. Again, I'm all about the back end on this to make sure that our investors do well and preserve the cash flow. If I need to get out and that means I don't get my fees for 2 or 3 or 5 years, so be it. I'll go raise the next fund knowing that I did the right thing for these investors. So those are really the markers for us.
Okay.
It's, we put 5 years with 2 1-year extensions as a timeline to allow us to fully take advantage of this interest rate cycle, not because I intended to own it for 7 years so I could get 7 years of fees. That doesn't, in the real estate world, that doesn't make any sense.
Yeah. Okay. So no, that makes sense. I was asking that because I know, in some of my conversations with the insurance companies that we deal with on the LP side, that question comes up about, if they hit a certain target, they're happy and you could technically exit at that point. It might be 1%, it might be 0.75% below your entry cap. But on the exit, from what you're saying, which I get, if the trajectory is still lower, then you're just going to ride that out.
Yeah.
And until something significantly changes that trajectory, why mess with it? Just let it continue to roll.
No, 100%. And I'll give you the example because people think about that and they say, well, you never know where the bottom is. And nobody knows where the bottom is.
Yeah.
But we're not talking about like public equities, like buying Amazon stock where you're trying to find a bottom, where you're guessing because it's moving around and all over the place. And you might find it, you might not. There's a longer run time in the cycle. So while I may not hit the bottom, I know the markers that will occur to say, hey, okay, we're starting to get soft here. Things may start to turn around. There's a much wider margin for error in finding that bottom so that I can afford to hang on for a little longer than I would if I was in the stock market, for instance.
Right. Gotcha. No, that makes absolute sense. And I will say, I actually forgot to tell our audience if they had any questions, they could have put those in the chat. I don't see any here, but obviously if you have any questions for Mike Kron, just let me know and we'll get those to Mike and see if we can get those answers for you. But Mike, this has been great. It's been really informative. I appreciate understanding the way you think about things. And, obviously that's led to the success that you've had. So that's quite a good thing from that standpoint. What would you want our audience to leave with today? As they look back and they say, wow, that's interesting. Do I want to do this with Mike? I'm sitting on the fence. What do you want to tell them?
I think I would tell people that, I've been doing this for 33 years. I've seen a lot of cycles and I know what they look like. That's, to me, the beginning and the end of the experience you need to be able to really operate in the real estate world is to understand the way the markets move and to have seen the ups and the downs a few times to know what those things look like.
Yeah. Well, very good point. Because, it's like an actor that would say, I've seen the end of this movie already. I know how this ends, right? So
exactly.
Yeah. So it's kind of like that, even though it's hard to see the forest for the trees when it's going on, but you always come through it on the backside. So
absolutely.
Yeah. Well, no, we greatly appreciate that, Mike. Sit tight for a second. We're going to close out. And I want to thank you all for being with us today. This has been the Mornings with Joel CRE Podcast. I want to thank again our special guest, Mr. Mike Kron. And we certainly look forward to having you guys with us next week as we cover another very interesting topic. Thanks so much and have a great afternoon.
Are you ready to level up in commercial real estate? Join us on Mornings with Joel CRE Podcast, where we bring you exclusive interviews with top deal makers, investors, and industry leaders. Sponsors reach a high-value audience of real estate professionals. Guests share your expertise and grow your influence. Don't miss out. Book your spot today